Good morning. Today is Tuesday, August 22nd, 2023. This is Arlington County Board of Equalization hearing. We have 5 members present, and Mr. Penaranda will be arriving around 9:30 and join us for our subsequent cases. We've got 6 cases on the agenda. We're going to start with the first one, RPC 14053-057 at 950 North Glebe Road. And Ms. Borman, you can start with your 8 minutes and tell us about that property, please.
Thank you, ma'am. So 950 North Glebe has a revised assessment of $77,043,400. The property was built in 2005. It has 247,000 square feet and is 55% vacant. Some interesting facts about the property are that their 12th floor took $25 to take to shell because it has 18 to 24-foot ceilings. The American Trucking Association, which is now in DC, had the 2nd and 3rd floors with an internal staircase and previously generated $4,500,000 of income, including $325,000 in pass-through. The building probably needs 2 large single tenants, or it'd be cost prohibitive to build out the 18 to 24-foot ceiling floor on the 12th. And if they don't get somebody, 1 tenant for the 2nd and 3rd floor, they will have to close off that stairwell space, which is going to cost an absolute fortune. The building ownership is converting old retail of 7,600 square feet to amenity space at an estimated cost of $8 million. And that's the amenity space and sprucing it up a little bit so that it looks rentable. Peraton was trying to sublease the entire 10th floor, and they have actually given up, but they've told the owner that they would be open to a buyout offer. The ownership hopes to get the building to 75% occupancy by the 2nd quarter of 2025 and estimates build-out costs at between $130 and $140 per square foot. The grounds on appeal, based on the test, capitalization rate should increase by 200 basis points. The rent on vacant space, the county used $40 versus $37.25 used by the taxpayer. The vacancy rate should be increased from 25% to 30%, operating expenses from $9.70 to $10. And the build-out deduction, which initially was $115, it was reduced to $90 in the test, and the taxpayer asserts that it's going to cost $140 per square foot to build out. We also believe a lease-up term of 2 years versus the 1 year is appropriate. County has support for its cap rate in its guidelines. There's market sales, financial markets, public sources, core packs. So looking at the market sales, these are the sales. The first 2 are sales listed in the county guidelines. The sale date, December, October, and October. The first sale sold for $10,600,000. The initial assessment was $21 million. So the assessment sale ratio was 201%. That clearly indicates that the guidelines are off because the guidelines are used to prepare the initial assessment, and it results in an assessment 101% greater than the sale price. We can't tell if there's additional FAR assessed on this property. But if it is just assessed as pure office, you would need to increase the capitalization rate used in the guidelines by 730 basis points. The next 2 sales are just office, 1776 Wilson, and we for sure. It sold in October for $59 million. It was assessed initially at $68 million. The assessment sale ratio was 115%. The property was 82% occupied at the time of sale. And in order to get to the sale price, you would need to increase the county's guideline cap rate by 100 basis points, again, indicating that the guideline cap rates are wrong. The third sale is 2445 Army Navy Drive. It sold in December of 22. Sale price $6 million. Initial 23 assessment, $8 million. That puts you at 140%. The assessment's 40% greater than the sale price. And in order to get to the sale price, you would need to increase the county's guideline cap rate by 294 basis points. We focus on the last 2 sales of 100 basis points, which would require a 100 basis point increase and a 294 basis point increase. And we believe that supports our request for a 200 basis point increase, as will other information. Now, county said it looked at the financial markets. Well, there haven't been a lot of sales, but the sales that do occur on a daily basis are the sales of real estate investment trusts. And what you see here is the pricing deduction or reduction from 1/3/2022 to the end of 9/30/2022, so the end of the third quarter. And the average REIT was reduced by 39%. As of year end, the average REIT lost 42% of its value. Now, these REITs do have office, hotel, and some retail and some apartment. And I would say to you that that only helps bolster their values because those asset classes are doing better than office. So we can see that the market has priced office, retail, et cetera, at least a reduction of 40% as a 43% in median as of the end of the year. Fed funds, you've heard it, they went up 425 basis points by the end of the year, clearly impacts the cost of capital. The CORPAC study was completed from what we have been told in August of 2022. The data value is January 1. The cap rate in CORPAC's study is 5.5%. Again, these are market cap rates to which the tax rate needs to be added to 7.76%. You'll note to the right, county's cap rate range is below the low end of CORPAC's range, 5.4% versus 5.5%, and below the high end of Mr. CORPAC's range of 7.76%. The top end of the county's market cap rate is 7.1%. CORPAC says you must use market rent. We all know that market rent is lower, at least predominantly lower, than old leases. The county uses old leases and market rent. Mr. CORPAC's rates state that are based on not including real estate taxes as a reimbursement where the counties are. Mr. CORPAC further states that cap rates bottomed out in 19, increased 2019 to 2022. The county has not changed its cap rate since 2019. Further states that rollover risk and high vacancy increases cap rates, and the county makes no adjustment for either of those factors. Cap rate conclusion, 2.36% increase in the 10-year T-bill, 4% increase in SOFR. The sales in the county indicate that the cap rate needs to be increased between 100 and 296 basis points, which reaffirms the taxpayer's 200 basis point increase. Further exercise of termination options, the rate return to work that never materialized in 2022, increased vacancy, reduction in space per person, lower rental rates, shorter lease terms, and increased concessions all increase the risk premium on buildings. The county used a vacancy rate of 25%. The property was 55% vacant at year end, and currently there's been negative absorption in the market. We believe that an additional vacancy tier for properties greater than a vacancy rate of 25% should be used, or a premium should be added to the already increased cap rate of more than 200 basis points. Next, expenses. DREA uses $9.70. DREA inspected this property twice within the last couple of years, and they know or should know that occupancy has been very low, physical occupancy, about 20%. The last time physical occupancy was stable was in 19, and expenses were $990.
Ms. Foreman, your time is up. Thank you. Mr.
Thank
Peralta,
you.
County.
Thank you. Just to reiterate some of the sales that the county reviewed in connection with our guidelines for 2022 sales, excluding the National Science Teachers sale, which is slated for redevelopment with apartments and the other retail that was included with the sale. We're at 83% sales assessment ratio for the remainder of the two sales in 2022. In 2023, the average assessment sales ratio was about 85% sales to assessment to sales ratio. So when we looked at these sales and we went back further just to give us a better pool of sales, we didn't opt to increase the cap rates for their office. What we did decide to do is, as we've done every year, is afford more deductions for the market rent. As you see in this case, the average lease in the building is $50.56. And that's the average of all the leases in place in this property. The county is using in the test $46 a square foot for the office lease space. And that's deducting the 10% concessions that the county has found when reviewing all the I&Es in the county. We did feel that 10% was reasonable to give concessions to lease up this property. In addition to that, what I'd like to point out, if the board would take a look at our test page on page 5 of 108, in addition to that, we're reducing all the rents on this property, the office, the vacant office, the retail, by 25%. So in addition to reducing it 10% for concessions, we're reducing another 25% on top of that. So if you look at the vacancy dollar for the first line item, office, we're deducting another 1,300,000 for that office lease space. We're deducting 1.2 in vacant office, and we're deducting another 35,000 in retail. And with that, it's a total of about 2.5 million that we're deducting for those market rents minus the 10% concessions. And that equates to another 25% of deductions there. So although we didn't increase the cap rates or decrease the cap rates as the sales suggest, we do make adjustments to the market rent that we use for this property, and as well as the other properties in the county. So when we look at this, we are, again, just to repeat myself, we're deducting 10% concessions. We're deducting 25% on top of that, and that's where the cap rate, our cap rate wasn't changed, but based on that, we did make adjustments year over year. As the board remembers, in the past, we've deducted 6% in the past. We deducted 10% this year. We're also deducting the parking. We're actually taking actual parking. We're taking actual pass-throughs. If this property were to stabilize, I would argue that the pass-throughs would increase, as in this case, pre-COVID, for the pass-throughs of this property, we see that in the collective of 6A, between 6A and 6B, you see all the pass-throughs listed there in 2019, column A. And then you compare that to what we have in our test, and that's almost 300,000 difference in real estate tax alone, whereas we're only capturing 87,300. We're only capturing a fraction of that figure, and that's pre-COVID. So when we're doing this test, and when you look at the original 2022 I&E, they're only projecting that they'll make that amount of money based on what is currently there on the property. And that is excluding 131,585 square feet of vacant space that they're not projecting forward for this property. Even doing so, if you compare column E to column F, you look at what they're projecting in NOI, and if you see that figure there, the county is right on the money as far as when we did our test. We may have overshot it in the original assessment, but in our test, we were more accurate and close to that figure. But again, I'd like to stress that figure in column E is an NOI that's projecting without the 131,585 square feet of vacant space. In DREA's test in column F, we impute that income, and also the appellant imputes that income as well. So even though they're not projecting that they'll make more money in that vacant space, our NOIs are in line with what they have as a current state of the property. And that current state, as Ms. Boren pointed out, is that vacancy of 131,585 square feet. Now, after reviewing their rent roll and going through the inspection, we did determine that only 124,445 square feet was vacant in the property. And that's a difference of what we originally did in the original assessment. We actually allotted more vacant square feet for the property. we had about 144,408 square feet vacant. And that's how we came up with our figure for the original assessment. And then adjusting in the test, we do see that there is a lot less, not a lot less, but maybe 20,000 square feet less in the property that is vacant. So I do ask the board to confirm this case, and we're open for questions. Thank you.
Okay, thank you. Questions from board members? Mr. Metzger.
Two easy ones for the department. On column G, excuse me. The top column G, appellant pro forma 2021. Is 21 a typo?
No, that was their review. They had a review in 2021. That's what their pro forma was.
I've just never seen it brought forward. Okay. And the other easy question is in column D, for the retail space lease rate per square foot is a little bit lower than what they had achieved apparently in the prior years. And in your test, though, you upped it significantly, almost 50%. What's that about?
Just looking at what the leases are in place. So if you turn to our page 6, you'll see that the leases for retail are only the Citizens Bank for $44.
Is there only going to be one retail, excuse me, retail space left? Could the rest going to amenities?
Yeah. So
Yeah.
so
That's a real figure, an actual figure.
right. The prior tenant vacated, and they're now turning the that space, Suite 130, into a conference center.
Okay, that answers them. Thank you.
Mr. Lawson.
Yeah, hey Rob, between D and F, below the line on F was reduced by about 5 million. Why was that done again?
The below the line, you mean from 115 to $90 per square foot?
These.
It's the
From there
difference
to
of the
there.
square footage.
Right. So the square footage, in my initial 8 minutes, I commented on we had over allocated vacant square footage in the original assessment, and then made the correction in our test.
So how many square footage was that correction?
About 20,000. I can give you a.
Does 20,000 make that much of a difference?
Well, so originally it was 115 per TIs, and then by virtue of our guidelines, anything under $45 would be $90 a square foot for TIs.
Other questions? No? Okay, Mr. Peralta, if you take a minute to wrap up then.
Yes, thank you. Again, I'd like to say that in our original assessment, we over allocated the vacant square footage by 19,963 square feet. We did make the adjustment based on that in our test. Again, I'd like to stress that the column E is just a snapshot of what it currently is, and they're not including any of the income that would be received from the vacant square footage. The department's column F does do so, and we do believe that if this property were stabilized, the pass-through income would increase, the real estate tax pass-through would increase, and the rent in place for this property, the contract rent would increase 2.5% to 3%, and that we know for sure based on the contracts and the increases year over year. So we do ask that the board confirm this case. Thank you.
Okay, and Ms. Foreman, if you take a minute to wrap up, please.
Thank you. Once again, this property is 55% vacant and has a WALT of 2.6 years. The biggest difference is the cap rate. I've gone through that, but if you change the cap rate, the base cap rate would go from 5.5 to 7.5, and the loaded rate would be 8.7%. Mr. Peralta keeps talking about absorption. The net absorption over the past 3 years has been minus 2.6 million square feet. And over the last 15 years, absorption has averaged negative 175,000 square feet. As of year end 2022, there was 8,600,000, almost 8,700,000 square feet of space available. The biggest year of absorption in the county was 2019, based at 1,000,000 square feet. Based on the availability at year end at 8.6 million, that's over 8 years to lease up the vacant office space in the county. I wouldn't be assuming if I was a potential purchaser that it's going to lease up the way the county has. And that doesn't account for the 2.5 million square feet under construction. Rent is too high on the vacant space. The county uses 40. It should be 37.25. The vacancy should be.
Thank you. If you're not going to use the timer, I'm going to have to just cut you off when your time is up. Thank you.
That's fine. Thank you.
Okay, it's just among the board members. Where are you?
I'm high vacancy, 50% vacancy buildings. I'm kind of trying to keep it simple and just look at what 2022 income was, and I think it's an eight cap, 72 million. We kind of got pretty close with the reduction from last year, but cap rate's still too low.
Where's everybody else?
I agree with Mr. Hoffman.
And where's the 8% come from? Just between the two parties?
Yeah, and I'm thinking back to some other cases, web building, we went with an 8.2, it's a little bit older. I think this building's better located, so, you know, in the market, I think it would fare a little bit better, especially considering recent institutional tenants.
Yeah, the interesting thing is they're converting space to amenities, and that's to try to attract new tenants. I saw one lease got signed yesterday in Arlington now. I forget what it was, but that's like the first one in months.
Was it in this building or another building?
Another building.
About the reductions that the department talked about in estimated income, anticipated income as an offset.
Yeah, I agree. I mean, my only concern is I look at column F and I like it with the exception of, as Mr. Peralta pointed out, you know, it almost mirrors column E, but it doesn't account for the vacant, the, you know, potential income off the vacant space, which if we're going to do the deductions below the line, that should be in there. So normally I would agree with you.
I'm not taking deductions below the line. I'm looking at it as last year, this building made $5.7 million after expenses, and at an 8 cap, that's worth $72 million to me if I'm buying it. And then they're probably not going to be moving forward in the next year with, you know, 16, 17, $18 million worth of renovations. I just don't see the market there for that. There's no justification unless it kind of came along and said, I want to take the whole building and this is what needs to be done.
Right.
So they're probably going to just get what they get from the existing tenants and try to keep people in place and renew at lower rates over the next few years. $50 is probably too much to try to renew somebody in there.
And the proposed reduction of 16% from last year, you don't think covers that, reflects that? I agree with you, right?
Yeah, it's just still a little too high. I just think the cap rate is just a little too high.
Yeah, I guess I'm just struggling because I see the 16% reduction and column E. And I don't know, I kind of lean more towards what Ken is. Mark, what about you?
And you're not taking any below line.
No. I'm just saying, it is what it is. This is I think that's the most defensible position, is to say, this is what we made last year. This is what the cap rate is for a 50% occupied building in Boston.
Versus 77.
Yeah.
So that's, which is almost equal. You're at 72. I don't think we can go down and just ignore below line.
Yeah, just. Below line stuff that may get through us.
What did you end up at, Greg?
72,088, 800,
And that was with what cap rate?
8.0.
22%.
At 8.0.
Yeah.
Okay, I see what you
Yeah,
mean.
and I'm sorry, and you used
I used
column.
the 22 actuals column.
Oh, that's why.
What I
It
did.
was close to that, but a little bit different.
Yeah, what I did is, last case where we adjusted cap rate, we went up by 1%. So when I did 7.695, I was at 74,858,765.
You
It's
said
a slight up of the cap rate you're suggesting.
would you use 7?
I use 7.6.
But what NOI did you use?
The only reason I did it that way, Mary, was
No,
that's what
I
we did.
just asked, no, I'm not asking why you did it. I said what cap rate or what NOI did you use?
Oh, the 5,760, 382 in column F.
Did that totally discount out anything below line?
Yeah,
74,858,000. That's what we got.
because I think that's what's in the market right now. That's what people are looking at. I don't think they're doing this kind of figure.
Yeah, they're looking at what you got, not what you could have, because there's too much uncertainty in that leasing market right now.
I don't think you're looking at what it takes to get it up to stabilize.
No, because nobody's gonna make that investment right now. It's like your funding costs could be higher than the cap rate you paid for it.
It's a major shift.
Like you want to get an office loan for value add to make these improvements. It's gonna be 9% in a debt fund. You're gonna get a mezz lender to charge you 12% for that money.
For construction.
So you're losing, right? You're negatively leveraged in that deal. So you would just sit there and you'd wait. You'd take the 5 million this year, which is going to be 4 million next year. It's going to be 2 million the year after. And you hope that interest rates drop back down in that time period. That's the gamble. Somebody makes it, they'll buy it from whoever the owner is. But we'll see. I haven't really seen any transactions on 50% occupied buildings other than extremely low numbers this year. Like, well,
So this is one of these cases that's unusually dire.
yeah, I mean,
We talked about.
if you're 15% vacancy, you kind of say, all right, I'm at 15%, maybe I can get 1 or 2 leases signed in the next year, and this is what it's gonna cost me. If you're 50%, it's hopeless. It really is. It's where we're at. So, I mean, I can get on board with Barnes, because I do know that this is a much nicer building than some other ones, right? It's institutional grade. It's right at the gateway to Boston.
And 66.
Yeah, visibility's good.
Think about it, if someone's gonna choose between the buildings and all this vacant space, which building they're going to, I think this is one of them.
It's attractive, yeah.
So it's access to all the universities.
What were you at, Barnes? Yeah,
74,858,800. 800. How close is this to Metro? 2 blocks.
I would go with this.
Across the mall.
All right, Mr. Lawson, I believe you have thoughts.
So then I'll make a motion, we reduce the assessment to 74,858,800. And by adding a 1% to the cap rate that was utilized by the county, making it a 7.695% cap rate.
I'll second.
Motion and second by Mr. Hoffman, all in favor? Opposed? Me? Okay, the assessment is reduced to 74,858,800 based on using column F, increasing the cap rate by 1% and no below the line deductions.
We're doing it because of the vacancy.
It's unusually high vacancy. Right,
Doesn't appear
that's my
in the
understanding.
Thank you. Moving on to the second case on the agenda, RPC 1803820, North Courthouse Road. Ms. Foreman, you can start with your 8 minutes in this record.
Thank you, Madam Chairwoman. This property, the assessment is $113 million, 135,000, and that's 100. That's a revised assessment. The building was built in 1990. The cap issues on appeal are the cap rate, 5.695% base rate versus the 7.695% base rate. In this case, there's an unusual wrinkle that DREA uses both future income and termination fee on the same space, which I'll get into later. The vacancy rate the county uses is 25%. We believe a 30% vacancy rate is appropriate. Operating expenses, the county uses $830. We look at $9. Build out deduction, the county uses $90. We used $115. And lease up, we used a 2-year period. County used a 1-year period. So what's going on here? We have Arch Properties. This is the Coke. They're moving into Boston Exchange. In November of 2022, they executed a termination option on 139,661 square feet, or 38% of the building. There is not a potential purchaser in the world that would capitalize Arch Properties' disappearing rent into perpetuity, which is what the direct capitalization rate does. No purchaser would impute pass-through income from Arch Properties into perpetuity, which is what DREA does. And the assessment compounds this issue by adding a termination fee in addition to capitalizing disappearing rent and pass-through. The taxpayer treats this occurrence, this termination, as a market participant does. We use market rent on vacant space. We added the remaining termination payment option below the line, and we added the Arch rental income, which is in excess of market rent below the line, and added the disappearing pass-through income also below the line. Vacancy rate. County uses a rate of 25%. With Arch Properties' known termination, there will be 244,000 square feet available, or a vacancy rate of 68% of the building. Given the negative absorption in the market, and another particular challenge facing this property is a new apartment building was built, which now cuts off the view of Georgetown and the cathedral. So one of the selling points is no longer viable. We believe that a vacancy rate greater than 25% should be used. Cap rate, again, I'm just going to summarize. We had a 2.36% increase in the 10-year T. We had a 4% increase in SOFR. The sales, 2 sales that took place year end, you would need to add 100 basis points to the second sale to get to 100 basis points to the county guideline rate in the second sale, and 296 basis points to the county guideline rate to get to the purchase price in the third sale. And we believe this reaffirms our 200 basis point increase in our cap rate. Risk premium in the market, exercise of termination options. Case in point, Arch Properties, 139,000 square feet. The failure of the great return to work to materialize. Reduction on space needed, shorter lease terms, increased concessions, tightening capital markets and lending requirements. Again, the county's range below Corpax's range, 5.5, they're 5.3. This property, they used a 5.695% cap rate. That is below the rate that Corpax thinks is appropriate for 875 North Randolph, in which he used a 6% as of January 1. This is a property that's going to have a huge vacancy and may never again reach stabilization. We added 200 basis points to come up with a cap rate of 8.85%. DREA uses 830 in operating expenses. The last time this property was stabilized was in 2019 at 866. A rate for property with a 30% physical vacancy, a minimum of $9 per square foot should be used, and higher expenses if a 25% vacancy rate is used. Absorption, again, net absorption over the past 3 years, negative 2.6. Year with the greatest absorption, 2019 at 1 million square feet. Assuming absorption at 1 million square feet, using the 8,700,000 square feet of vacancy in the county, it would take 8 years to lease up the vacant office space in a market when people are reducing their space needs. And this does not even account for the 2,500,000 square feet under construction. In conclusion, Arch property space is double counted by DREA because they capitalize a disappearing income stream and add the lease termination fee. Operating expenses used in the test are too low at $830 versus $9. The vacancy rate is too low. The cap rate should be increased by 200 basis points or 2% as supported by the 10-year T-bill and actually adjustment of the county sales to 100% of purchase price, which indicates an increase in their guideline rate of 100 basis points to 294 basis points. Build out taxpayer uses $115 versus DREA's $90. And we use a 2-year lease up period, given that there's 8 years worth of space available in the market. Thank you.
Thank you. Mr. Peralta for the county, please.
Yes, thank you. For this property, we look at it as what was the current vacancy as of 1/1/2023. And as of 1/1/2023, it was 22% vacant. Now that included Arch Properties because their lease isn't over until November 30th of this year. So we are actually taking below the line adjustments when our date of valuation as of 1/1/2023 is what the property was at 22%. So in our test, we did take in consideration that they would lose Arch Properties. And by doing so, we deducted below the line. So when you look at our page, our test page, we're actually deducting 221,022 square feet, which is equivalent to 61% vacancy on the property. So we are taking into account what the tenant situation will be for this property with Arch Properties leaving. And we are not capping out the termination fee, which they will pay of $3,253,200. So we did, as the appellant has done, included that termination fee below the line, but we are capturing what they're actually getting on the property for the rest of this remaining year. So with that, this is how we've done other properties in the county that experience tenants leaving in so many years after the initial date of valuation. I'd have to argue that maybe we shouldn't, because what that does is keep moving the ball, forward. But what we don't receive in return is these new leases that come into play within that time frame. We're uncertain of what the leases are, and you'll see in the next few weeks with cases that come before you that there are leases being signed in the county, and there are leases that are signed within 3 months. Just to compare, what we received in the INEs to what we're seeing when we go visit the properties and what we're looking at in CoStar. So for this property, we are treating it as we see all other properties in the county with excess vacancy. We take it a step further and adjust below the line for the 139,661 square feet that will be vacant at the end of this year. And by doing so, we're allotting $18,350,700 below the line to account for those increases in vacancy for this property. Now, looking at our original assessment, based on the information that we had in column C, the 2021 INE, our NOI goes to show you exactly how the county has adjusted our rates. They're looking, in 2021 of an NOI in row 20C of that figure there, and we're 2 million below that figure, 2,500,000 below that figure. And in the operating year 2022, they're projecting a higher net operating income than what we originally had, and we're going even lower in the test in column F to project a lower stabilized income for this property. And in addition to that, again, taking the 18,350,000 below the line. And what this number represents in column F, the the final value that we arrived at, that represents a 17% decrease from last year's assessment. So if that doesn't adequately show that the county is making adjustments based on the information provided, then I don't understand what we're doing here, but I would ask that the board confirm this case based on what we had originally for this assessment and based on our test that is supported by the most recent 2022 INE. Thank you.
Okay, thank you. Questions from board members? Mr. Lawson.
Yeah, why is the termination fee below the line?
It's a capture that they're going to receive that money as a termination fee for the property. So if a future purchaser would buy this property as is right now, that they know that termination fee would be received by the new owners, as is the appellant agrees.
Is this the second half of the two-part termination fees that you're talking about?
It's half.
First half.
November 23
Yeah,
to be received.
on November. So that last year they paid.
Yeah, they paid half last year. That's what I
Right.
read. That's what I want to know.
So why is that?
When we're
I don't
talking.
understand why that's below the line.
Mr. Lawson, we agree that the termination fee should be included below the line, but we think that you should either get the termination fee or the rent. If you're going to capitalize that rent into perpetuity, which is what the county does, then you shouldn't take the termination fee because then you're double dipping. But if you take a market rent, you should, in fact, add the termination fee below the line, and you should add the.
Why is it even addressed at all?
It's a good question. We believe that it doesn't necessarily run with the land. So it could go to the current owner if the property was sold on January 1. But we did include it because we also took market rent on the Arch property space and added the delta or the difference between the market rent and the Arch properties rent.
If the lease is terminated and the property is sold, that termination fee does not go to the new owner.
That is correct.
Okay.
Okay, other questions?
Yeah,
Okay, Mr. Peralta, if you take a minute to wrap up.
Yes. So the termination fee is not in perpetuity. It's just one-time below-the-line adjustment, just to account for this is a significant amount of money that will transpire once they terminate the lease. In addition to that, we're using 4225 for the leases for the vacant space. For the leases in place and 3825 for the vacant space. 3825 is similar to what the appellant is showing there. In our test, we use 3825 for the vacant space. Again, we're accounting for a large sum of below the line adjustments of 18,357,000. We do state that it's a 17% decrease from last year. We do see that the NOI does support the original and the test figures, and we ask the board to confirm this case. Thank you.
Thank you. Ms. Foreman, if you take a minute to wrap up, please.
Thank you. The 17% reduction is wholly inadequate. We can see here that the commercial real estate market has plummeted from January 3rd, 2022 to the end of 2022 in excess of 40% as priced on a daily basis through REITs. The conclusion, I'm just going to go through in conclusion, the taxpayer uses a more realistic build out of $115 per square foot. No potential purchaser would capitalize the Arch property space at an above market rent. They might impute market rent and then add the additional delta between the market rent and the Arch lease below the line. Operating expenses are too low. The cap rate is way too low. This is a property with huge upcoming vacancy. And the cap rate, even according to Mr. Korpak, should be increased for roll and high vacancy. We increased the tax cap rate by 2 basis points. Thank you, 200.
Okay, just among the board members.
Yeah, I don't think it's going to.
Mr. Matzkin,
No, no.
No, no, no,
well, that be on the record. So,
Okay.
Mr.
Okay,
Matzkin.
great. I have 2 points to make for us. One is, I support, because I run into it all the time, support lower TI for lower rents. It's all about how long does it take to get my build out costs back. Now, whether it should be $45 or 44, I mean, you know, you got to cut it off somewhere. So we hear that argument a lot, and I don't support it. The other argument we hear a lot chronically is writing off below the line those TI costs plus other costs, lease-up costs, for more than a year at a time. We absolutely have net negative absorption in this county, no question about it. But there are winners and losers. As the department said, there are leases that are going to be signed by somebody. This building, maybe not. We don't know. We're not seers. And if they are not one of the winners this year, then by God, next year we're going to have another year's write-off. So that argument never did, and as far as I can tell, never will sway me. And those are the 2 points I wanted to make.
Okay, Mr. Yates.
You know, my biggest concern is the amount of vacancy. I think they're correct and below the line. And it didn't come up as strong as I thought it would, but the fact that we're looking at 25%. Really doing pretty big. I think the other numbers are pretty correct.
Yeah, I mean, the only thing that came up that didn't really get resolved was the timing of the termination, but it was in the package and it was, you know, October of 22. There's a letter and certified, signed, all that. So to me, that's information known and effective as of January 1.
How does that change?
It goes from 22% vacant building to a 68% vacant building. So it's
That's where my numbers.
yeah. So to me, that's a big push in the cap rate.
And they have 10 months to backfill. Maybe some of it, maybe none of it, maybe, you know.
Right,
all
they're
of it.
receiving rent.
And they're receiving rent.
Right, see, that's where I don't have as much.
Kids are getting rent. Most importantly.
Yeah.
Well, but I think that's where I'm thinking that number is 25 versus 30%. Yes, they're receiving rent. But it's known that it's going to be 68% vacant.
I mean,
But
We're not.
again, this is as of January 1.
Right,
We
it
just
could
happen
be
to be hearing this
50% vacant.
in August.
Yeah.
You know, but as of January 1, they had 10 months worth of rent coming in on it and 10 months, you know.
I know it's just this year,
Yeah.
but I still, it's a hell of a number.
Here, I think this is being done correctly this time because of the fact that the lease isn't, we know it's going to expire, but it hasn't yet.
Right.
So I think the below the line, leaving the cap rate and doing below the line is appropriate this time. But why is the termination fee below the line? That's what I don't get.
I mean, it's a one-time thing, you know?
It's
Yeah,
real
that's the same
additional
thing.
money coming in.
Because was it reflected income?
As I read the letter, they said they've sent it in or they were sending it in October. So it's probably due at the time of
It's-
the termination, not, I mean, as the landlord, I wouldn't say, hey, my termination fee is due whenever you get around to it. It would be due effective immediately.
Sure.
Yeah.
But they're going to pocket this money.
They probably already have.
Yeah, that's,
And it's not above the line, but it is real money that they've received.
I don't think it should be addressed at all. But maybe that's just me.
They're going to be taxed.
If we don't address it at all, then we up the bottom line by the 3,253,000.
I mean, both sides agree that should be there.
All right, well then
If they agreed to.
I'll concur with my colleagues.
All right, so we're good with the
I'm okay with the revised system.
motion.
I'll go ahead and move that we reduce the assessment to the revised Number of 113,135,100.
Second.
Okay, motion a second. And Mr. Metzger, all in favor? Aye, opposed. It's unanimous. It's reduced to the county's recommended number of 113,135,100. Thank you. Moving to the third case on the agenda, RPC 14044-260, 875 North Randolph. Ms. Foreman, you can start with your 8 minutes on this property. Turn your microphone on, please. Foreman. Turn your
Sorry,
microphone.
I was having technical difficulties. All right, so I'm sorry, I will start now. So this property, 875 North Randolph, sold in 2019 for $151,200,000. This is a GSA lease. The 2022 assessment was $151,500,000. The 2023 assessment went up by $6 million to $157,300,000. The building sold, and here's a picture of the building. When it sold, it was 99% leased to the Office of Naval Research. There was 8 years left on the lease. As of January 1, 2023, it was still leased to the Office of Naval Research, and there is less than 5 years remaining on the lease. The tenant has a lease prospectus out to the market for the 2027 lease expiration. Cap rates have increased since the time of sale, and so we would ask that the assessment be, the cap rate that's used be increased. The grounds for appeal are operating expenses and cap rate. Operating expenses in 2020 were $789, in 2021, $715. 2022 was an aberration with operating expenses at only $5.89. There was some credits given for a management contract and a new electric provider in 2022. In 2023, the property is on trend to have operating expenses of $8.01 per square foot. And the 2024 budget includes operating expenses of $8.39 per square foot. The grounds for appeal include the cap rate. Again, we had a 10-year T-bill increase of 236 basis points, an increase in the SOFR of 4.1%. And the guidelines, when looking at the assessment sale ratio, lead to assessments in excess of fair market value. One of the things I'd like to point out is on this property, the county used a base cap rate of 5.6%. In their package, they state that the cap rate should be 6.1, as of the time of sale was 6.14%. Cap rates have only increased since 2019, and we increased the cap rate on this property by 75 basis points. And why we did that is because the owner of 675 North Randolph, who is Boyd Watterson, and they purchased that property, which is in some ways a sister building. That's the DARPA building. They bought that building at a 6.14% cap rate, just like this building, which was bought by USAA. And they said that in their opinion, cap rates had increased between 75 and 100 basis points for that sale as of January 1, 2023. Now, these are low cap rates. And why are they low cap rates? So both the USAA fund and the fund, the Boyd Watterson fund, are simply that, funds that have to invest money, that have cash, and they have certain investment criteria. And their investment, and they compete with properties with each other a lot because they have the same requirements, government tenants for both of the funds. And so the county says, as of the date of sale, 6.14, there was 8 years of lease term left. Now there's less than 5 years lease term left. The cost of capital has gone up This property has, the tenant in this property has a prospectus out seeking bids for space as of the expiration of the lease, so it's clearly riskier than it was, with 3 years less lease term and a prospectus out in the market, and the increase in cap rates. So we believe the cap rate that's appropriate on this property is 6.89%. Now, uniformity. So we have said that uniformity is to be preferred, but there is an assessment can't be made in excess of fair market value. So in this case, the county's uniformity guidelines for vacancy, and just like any appraiser would look at the property, a 5% vacancy rate is appropriate. And if you turn to the taxpayers' case, excuse me, if you look at our pro forma, it's going to have different numbers than the county's test page. And our pro forma is on page 37 of 106. And what you see there is an NOI that is adjusted for a 5% vacancy rate. So what we'd ask that you do is use a 5% vacancy rate on this property, that you use an operating expense that is closer to $8 a square foot, because that is what is trending for 2023. And we have heard time and time again, we are prospective looking, not backwards looking. And that you use a cap rate of market cap rate of 6.89%. Doing that gets you to the purchase price of this property of $151 million. Now, what you see here is the difference between the cap rate 5.6 versus 6.89. And again, I remind you that the county references the sale cap rate in 2019 of 6.14, which we have confirmed. Add the tax rate for the submarket, and you get to an 8.09 cap rate. The sale in 2019 at $151 million, 200 is the upper end of value that is appropriate for this property. The operating expenses used in the test are too low. 2022 is an aberration. The taxpayer is entitled to a 5% vacancy credit. Remind you, if the property is vacant just 1 out of 10 years, that is a 10% vacancy. So a 5% vacancy credit assumes that the property is vacant for only 1 out of 20 years. And again, this lease expires in 2027, and there's a prospectus out in the market. The county's guidelines are not supported by the sales, the financial markets, or their own expert. Taxpayer increased purchase cap rate by 75 basis points from 6.14 to 6.89. And that is based upon the estimate of 675 North Randolph owners. Thank you very much.
Okay, thank you. Can you
I'm
take
going
your,
to try. Yes.
Mr. Peralta for the county?
Thank you. For this property, we do feel that this property is stabilized Liberty Center as the GSA tenant in the building. As you see in the 2021 year, column C, the gross potential income for this property grew from 21 to 22 of, let's say, 300,000. And in that time frame, if you compare the department's original assessment, which is 500,000 more than what we had, what they projected in 2021, but in the test column, we're actually 600,000 less than what the potential gross income of the property is in 2022. So when you compare those figures and you look at the bottom line, the NOI, you'll see that over the years, the county has been lower than the past 2 years, excluding the first year, 2019, which is a partial year depiction of what was received that year. But in 2020, in 2021, and in 2022, the department's original assessment and the test are well below what they reported in their income for those previous years. The county does afford the 5% vacancy, although this property is 100% vacant. And it's interesting to see the shift in, we'll agree to the guidelines for the vacancy part, but we don't agree to the cap rate. Those those figures are all done simultaneously. We do take a look at all of those combined at the end of the year. And that's what we use to derive our assessments for the coming year. So with this case, we do feel that it is stabilized. We have another 4 years. The lease ends for the GSA in August 30th of 2027. So that's another 4 years of income that this property owner can count on. So we do ask that the board take that into consideration and confirm this case. Thank you.
Okay, thank you. Questions from board members? Mr. Yates?
Minor one. I mean, you said the expenses are an aberration.
Correct.
I hear why that is. I heard that they changed the electrical and things like that, which to me says it's still be going down.
So the expenses went down by about, there was a reduction in 2022 for the management fee by about $80,000. Electric was down by, and Jordan, I know you might have this email up. If you can tell me if I'm wrong, the electric went down by about $200,000. So what you can, we always look at trends, right? So in looking at the trends on this property, the 2022 was just, as I said, an aberration. And those are the reasons. It was a management fee credit. It was a change in electric, but they are on track this year for $8.01.
Okay, thank you. Other questions?
No. That's not right.
Yeah.
Okay.
Well, what
Mr. Hoffman?
was the change in electric? Did they put in sub meters or something like that?
No, they changed the electric provider.
Oh, okay. So the rate.
Correct.
Yeah.
So it popped back up.
That's not an aberration.
Okay, Mr. Metzger.
Yeah, okay, thanks. For the department, all the columns show square footage of the building, 319,000 plus. On the top left, the NLA is 318,000 plus, which is the right number.
It's 319,577.
Okay, so all your numbers in these columns go by 319. Okay, and the reason I asked specifically was, and I'm glad the question and answer we got just before, I thought the proposed operating expenses was in the test, column F is probably too low, but now that I understand the situation, it's not as egregiously too low as I had thought.
If you do look at the trend from the last 3 years, the expenses are going down.
Yeah, no, and the appellant, yeah, the appellant described why it's a good thing for the landlord and the tenants, got investors. Okay.
Actually, that I don't want what I
There's
said to be
not question on the-
mischaracterized.
There's no question.
Well, Mr. Peralta seemed to jump in, so I feel like I need to jump in and explain what he said.
I'm sorry.
Got it.
We got it. Other questions from the board members? Ms. Peralta, don't jump in.
I apologize.
Okay. Mr. Peralta, take a minute to wrap up.
Thank you. Again, for this property, the history of this property and going forward for the next 4 years would net out an income that's higher than what the original assessment is and what the department tested in column F. I do ask that the board take that in consideration and confirm this case. And again, the trend that I see in columns B, C, and E is the expenses trending downward. So we did try to take that in consideration when doing our test, but if you look at the original assessment as well, we're at $8 per square foot. And so the original assessment is what we're asking the board to confirm. Thank you.
Thank you. Ms. Foreman, if you take a minute to wrap up, please.
Absolutely. The operating expenses in 2021, this is the building, just like every other building in the county, while it was occupied, it was not occupied as densely as historically. In 2022, the expenses are an aberration. If you look at the 3 years, the prior 2022, there was a credit because of signing on with a new electrical contractor. and new management company. So the expenses this year are expected to go back up with the building being fully utilized and any credits gone to 801. All of the income was known as of the date of purchase. And what we see in the fact that the county's income is lower is that the cap rate is wrong. Clearly, the purchaser knew what the income would be when they bought the property.
Thank you. Okay, it's just among the board. Counselor on this, I mean, aberration or not, I think the assessment is fine. I mean, when you look at it, if you look at the NOI, it's lower than 2021, 2022.
Mhm.
So, you know, it's because the EGI is lower. You know, if that was higher and then you could increase the expenses, you'd come out with the same number anyway. So I'm fine with the assessment. I'm not sure also why we're even hearing this. I mean, we didn't have issues with something that had 1 year left to pay. This saw us 4 years left to pay. So I think this is premature coming to the board.
Yeah, it's a little odd that went up, but other
Yeah.
than that,
I'm also fine with it, but I do, given what was just said, is the electrical reduction was a one-time thing. She didn't say that. But is it going back up or not? I think that's a question I don't think we have an answer to.
Right.
I gotta go with this.
Yeah, we'll see it next year.
Change providers, and this is a cost-effective
There was
provider.
one, it sounded like a one-time thing.
I think they went back to the more expensive
Yeah,
provider.
Well, it should be just, hey, we're changed to us and we'll give you a discount here.
you charge you more after
Yeah,
that.
so I don't know. I don't have that answer, so I'm fine with this.
Well, interestingly, I mean, you're not gonna get a better stabilized building than this. The federal government the next 4 years, excuse me.
Yeah.
I mean, you can't do better. But I did look at operating expenses and I thought, and this is maybe negligible, but maybe appropriate. More I think about it, because it's a projected 4% increase. I don't think the federal government's paying a 4% increase in rent from 22 to 23. And so I took the appellant's number and rounded it off to $6 a square foot. In other words, 25 cents more per square foot, and said, well, that's operating expenses more of 1.174 million plus. And so I capped that out and reduced the final result then. I'm sorry. The operating expenses are 79,000 plus. I capped it out and made the assessment 1.1 million plus. And therefore reduced it to 156,153,300, which gets it to the 3% range. I'm sure the government's probably paying 2.5% annual increase. So I shaved it off, but you know, modern times now, tests $500,000 less, 0.5%. The county's recommending that they get that 0.5% or so. So I'm recommending that we do the same thing.
Right, because I would disagree with the test. I think it was too low to
Just like
start.
the income was too low.
Yeah, on the test. I mean, if you took that same number and took it off of the original assessment, you know, you might have a stronger argument to me, but like I said, I think we're in the weeds now.
Yeah, we're getting close.
Yeah.
Sure,
Pretty
for sure.
close, yeah.
Yeah, I'm not insisting. I just threw it out there to try to refine
okay.
it a bit.
The income stream is the same,
Right.
but if it were sold, whoever bought it would pay a higher interest to obtain that income stream. My thinking, and I think I'm in a minority here, my thinking was just to leave it where it was last year. But I don't think I have anyone else that agrees with it.
No, to me, I don't see a need to do that, but you've got a very strong tenant with a 4-year lease. I don't see lowering it.
Yeah, this didn't come before the board last year either, so it wasn't
Right.
as deep a dive into that number.
This is for investors, this is an awfully attractive property.
Yeah.
And they may stay. They are not looking, but they may stay.
Right.
4 years
4
down
years
the road.
alone,
Yeah,
no.
Navy's been there a long time. They've been there since day one.
And the county has proven that they will
Okay.
step up to the
Yes.
plate if needed.
I'll make the motion to confirm the county, original assessment.
State number.
157,000,000, 310,300.
Motion to second. Second. All in favor? Aye. Opposed? 42, and that's without Mr. Maston. Mr. Watson. The county's confirmed at 157,310,300. Thank you.
Thank you, board. Thank you, Madam Chairwoman
Thank you, Eileen.
and county.
Okay, do we need a break or are we going to keep going?
Yeah.
Okay, we'll move on to the fourth case. You got Mr. Harmon, there we go. Economic unit 1702402A at 1800 14th Street North. We have Annetta, okay. Mr. Harmon, you can start with your 8 minutes and tell us about this property.
Yes, thank you, Madam Chairwoman, members of the board, members of the DREA, good morning. This is the Gables Point 14 apartment building and courthouse. It faces Highway 50 at the bottom of the hill. This property has 370 total units, with 39 of those units committed affordable. It was built in 2019. The 2023 assessment represents a 21% increase over the 2022 assessment. The issues on appeal are the vacancy and collection rate, the operating expenses, and the cap rate. To start, I want to mention that I'll be discussing the market and affordable units combined, since that is how the owner operates the property. The applicable columns for this analysis on the test page are the totals that appear in between the DREA columns F and G, and column H, which is the property's 2022 actual income and expenses. So starting with the vacancy and collection rate, you can see that this property had 7.3% vacancy, collection loss, rent loss, and concessions in 2022. This is the lowest amount of any of the past 4 years at this property. The assessment imputes a combined rate of only 5.8%. This property, per the DREA write-up and the assessments, has been stabilized since 2021. Over these 2 years of being stabilized, the property has had vacancy and collection loss that averaged 12% and again was over 7% last year. Clearly, this is an issue at this property. The property last year saw 217 move-outs, or 60% of the total units. The owner for 2023 anticipates move-outs to be even greater, projecting 271 move-outs, which is nearly 75% of the total units. Additionally, 6.2% of the units were vacant on average over the course of 2022. The owner also projects collection loss to more than double in 2023 from 2022. With move-outs and collection loss both projected to increase from last year, clearly 5.8% as imputed by the assessment doesn't capture the magnitude of this issue at this property. Next, the assessment projects operating expenses to decrease in 2023 from 2022. This is despite the CPI having increased by 6.5% per the Arlington Economic Development's Q3 2022 report. This property was, again, built in 2019. With this, new properties typically do have lower expenses in their first few years due to the materials being covered by warranties. Projecting operating expenses to decrease is simply not supported by either the CPI or the age of the building. Now, finally, the capitalization rate. The assessment imputes 2 cap rates, one for the market units, another for the affordable. What is shown on the DREA test page as cap rate actually consists of 2 numbers. What's shown there is the market cap rate plus the tax rate. Removing the tax rate, we see that the market units are assessed at a market cap rate of only 4.12%. The affordable units are slightly higher at 4.87%. These are the lowest cap rates applied by the DREA in any of the past 15 years and remain unchanged from 2020 when they were lowered to their current levels. This simply misses the mark for cap rate for 3 reasons. First, interest rates climbed significantly over 2022, increasing by 425 basis points. This increase was matched on a 1-for-1 basis by the SOFR, which represents the minimum interest rate on commercial loans before any profit or risk premium is added. The 10-year T-bill, the risk-free rate of return, increased by 236 basis points and ended the year at 3.88%. Now think about that for a second. One of the safest investments in the world was paying 3.88%, while the DREA cap rate for the market units at this property is only 4.12%. The spread between the 10-year T-bill and the cap rate is less than 25 basis points. That means profit and risk for purchasing and operating a multifamily building is less than 0.25% over the risk-free rate. We know increased interest rates, especially when the increase is the greatest of any of the past 50 years, as occurred in 2022. We know this directly impacts the value of commercial properties via the cap rate. Peter Rothman, the co-head of strategic research at Green Street, which is an independent commercial real estate research and advisory firm, stated last November that higher yields on treasury bonds equals higher cap rates. Steve Gilbert, director of applied modeling and analytics for JP Morgan Investment Banking, stated also in November that cap rate levels are generally a reflection of other larger economic factors, including rapidly rising interest rates. Add to this the fact that it was known that the Fed would continue to raise interest rates in 2023. It is simply not plausible that cap rates did not change from 2022 to 2023. In further support, the Delta Market Makers survey of local investors and developers found that the market believes apartment cap rates increased by 93 basis points at year-end 2022 from 1 year prior to an average of 5.11% for Class A high-rise buildings. We have conservatively imputed only a 75 basis point increase year over year. To provide some context on just how large the 10-year T-bill increase in 2022 was, the average change over the past 15 years, excluding 2022, is 75 basis points. Sometimes the 10-year T-bill increases, some other times it decreases, but the average movement over any 1 year is less than a third of what 2022 experienced. Next, this property has greater risk than other properties in the county because of its vacancy and collection loss issues. If the DREA is telling us the market vacancy and collection loss rate is 5.8%, and this property is consistently above that rate, then it is riskier than other properties. Add to this the fact that the owner projects move-outs to increase in 2023 and collection loss to double in 2023. And it is clear no market participant would fail to account for the increased risk presented by this property as of the date of value. Finally, with the cap rates, the rent increases achieved by the multifamily market over the past 2 years began to plateau as of the end of 2022. The underlying assumptions that may have supported the DREA's cap rates the past few years have changed, and it was known as of the date of value that rent increases were returning to a lower, stable rate. In summary, the assessment again represents a 21% year-over-year increase. The property has experienced a minimum of 7.3% vacancy and collection loss over the past few years and expects move-outs and collection loss to increase in 2023. The assessment projects operating expenses to decrease in 2023 despite widespread inflation, and the assessment only assumes a 24 basis point spread on the cap rate from the 10-year T-bill rate at year-end 2022. For these reasons, we respectfully request the board to reduce the assessment as set forth in the appeal. Thank you.
Thank you. Ms. Shuttlesworth for the county, please.
Yes, good morning, everyone. So for this case and for my other case that I will be presenting today, it seems that the cap rate is the biggest contention. So we still did our due diligence. We analyzed actual rent rolls provided as of January 1, 2023, and we have also analyzed the I&E surveys. We believe that the income reported for 2022 is stabilized. We have also, based on the actual rent rolls, determined that the apartment income and the parking income we used in our 2023 assessments were understated. Our GPI used in 2023 assessment was significantly below the GPI the appellants reported in the 2022 I&E survey. We have also determined that our OPEX ratio used in 2023 was understated. The total vacancy and concessions reported for 2022 experienced a significant decline from 16.69% to 7.25%. The OPEX reported for 2022 actually decreased from 31% to 25.64% when compared to 2021. In our test column F and G, we separated the market units from the CAF units. Based on the actual rent roll provided by the appellants, we increased the apartment income. And based on the conversation with the property manager during the on-site. Hello? Can you hear me?
We can hear you.
Yes.
Oh, okay. No, I heard some background dialogue. So in our test column F and G, we separated the market units from the CAF units. Based on the actual rent roll provided by the appellants, we increased the apartment income. And based on a conversation with the property manager during on-site inspection, we increased the parking income, which is still below the parking income stated in the appellant's 2023 pro forma. Also in our test columns F and G, our OPEX is at 26.15%, which is above the OPEX ratio reported by the appellants in 2022. The NOI produced in our test column F and G is below the total NOI reported by the appellants in 2022. It is also below the NOI projected by the appellants in 2023. The appellants used the cap rate of 5.92% in their 2023 pro forma. Per our 2023 guidelines, we used 5.15 cap rate for the market units and 5.90% cap rate for the affordable units. And I also wanted to talk a little bit about the argument, the cap rate argument. The appellants argue our cap rates based on 10-year treasury note. As of December 31st, the 10-year treasury note was at 3.88%. And as of January was at below 1.7%. I wanted to talk a little bit about the guidelines we use in our mass appraisal process. We use several metrics in our assessment, and 10-year note is not one of them. We use sales to assessment ratios. These ratios were below 100%. As you could see in our guideline book, we presented the sales that we used in our assessment. We determine, based on hundreds of INEs we analyze, we determine whether the cap rate needs to be moved, or we might decide that we move OPEX ratio or vacancy and collections. And it doesn't have to be always cap rate. We also are we have very strict timeline guidelines which we need to follow, and our cutoff date is January 1, which I wanted to remind the board of. Now, when looking at our summary sheet, as you can see, we were more than fair in our test columns F and G. Our EGI actually is only 200,000. It's almost 200,000 below of the EGI they reported for 2022. We significantly increased our operating expenses, as you can see, and effectively NOI in our test column F and G is still below the NOI they reported for 2022. With that being said, I wanted to conclude, and I'm open for questions. Thank you.
Okay, thank you both. Questions from board members? No? Okay, Mr. Metzger.
It's developing, and I have two for the department, very close to the same question. Operating expenses. Reported in 2022 was
2.7.
No, I get my finger on it. I have the number. And you're accepting that in your test. And I guess I was looking at the percentages and, okay, so let me go back to the other question. On income, in 2022, this is the one I was developing. The income, you show it as a vacancy and concessions, you show it as going down percentage-wise a good bit from what was achieved in 2022 in your test. It was 23,000, and you got projected blended, which I appreciate, to 641. What is the case for that? I mean, that significant percentage decrease over 20%. Could you explain that, how you made that determination?
Yeah, so when you look at our mixed use worksheet, you can see we separated market units from CAF units, and we use different guidelines. So for market units is 6% vacancy, and for affordable units it's 3% vacancy.
That's the answer. Okay,
Yeah.
thank you. That's a good answer.
Okay, no other questions? Ms. Shuttleworth, if you take a minute to wrap up, please.
Yes, so to conclude, I don't have anything else to add. However, I do ask the board to take a really close look at column D and column E on our summary sheet and compare our GPI, EGI, and NOI to the numbers actually achieved and reported by the appellants on the 2022 INE survey. Thank you.
Okay, thank you. Mr. Harmon, if you take a minute to wrap up, please.
Yes, thank you. I want to first look at the apartment sales that they referenced in the guidelines. So the first sale, the RCA building in Roslyn, that was sold as a redevelopment site. The next sale, Patrick Henry Apartments, is committed affordable apartments down Wilson. The next 4 sales were Cortland purchases. These are all Q1 deals. We spoke with that owner. They said the price they paid in Q1 of 2022 is not reflective of as of January 1, 2023. The next sale they have is coded on their website as not a multiple RPCs, not a coded sale. So that takes us back to the beginning of the year before most of the interest rate increases had begun to take effect. As of the end of the year, those interest rates had increased by 425 basis points on the SOFR and 236 basis points on the 10-year T-bill. Thank you.
Okay, thank you. All right, it's just among the board members. Where's everybody? Mr. Lawson.
Yeah, I'm going to share some thoughts. I think this is a cap rate case. Either it's adjusted or not. I did a little bit of research in preparation for this morning, and according to the national cap rate for multi-unit residential, the last quarter of 2022 was 4.49. I then looked at what's going on with rents in Arlington, and the average increase per unit per month rent is $87. So last year it went up by an average all over, 2-bedroom, 3-bedroom, 1-bedroom, 87. Now I do know that interest rates have risen. And so I guess the question is, does that rise in the interest rate, is that applicable to Arlington? I do know for a fact with new projects, it is impacting. Whether it's impacting with something already done, I don't know. What I've been reading lately in Wall Street Journal and others is that this has been the safe haven. This is where, this was the safety investment. I'm reading now that as loans come due, people are having to put more money in, or they're having to pay more. So when I look at what the county's saying and what the applicant's saying, the 5.9 suggested by the applicant is that 1.5 added to the 4.49. County isn't changing it at all. My belief is that Arlington is unique. And I'm not convinced we have to adjust cap rate for multifamily residential. I'd like to hear what others think.
Sure seeing a lot added to inventory, I'll tell you that.
Yeah, and are we gonna
Developers
outbuild it?
agree
So,
with you.
I mean, this is 1% vacancy, 1%.
This property.
Yeah.
Have a,
Go ahead,
oh, no,
Mr.
Mark
Yates.
first.
One of his closing arguments was that the properties that were purchased previously, his last statement was they all said they wouldn't pay the same thing in third quarter of 23. That's not what we're looking at.
Right, so-
Yeah, so they paid what they paid, and that was based on the rates then. And that's what we should.
And we have an assessment period that we agree on.
Yes.
For rational
So
reasons.
the argument for this cap rate, I think is off. Next year make it, but not this year.
Right, and they
Right, you
have-
have a project that's multifamily right now. What do you think?
You just hold on to it and you hope you already financed it. You got the
Yeah.
arm on the loan.
Right.
Right? And so what we haven't seen yet is a cascading group of sales under distress on multifamily, where we've kind of started to see this in office.
Yeah,
And so that tells me that Gables and Mill Creek and all these companies are holding on to these properties versus selling them. So we really don't have a situation like with office where it's, I'll take any number for this office building. I was okay with the assessment. I mean, the only thing is it's minor. I wouldn't even really worry about it in this case. The appellant's not arguing it, but we had another appellant where they committed affordable portion. They said, I think they testified it was like 40 to 60% collection losses. And to use 3% is probably a little low. And I'm sure it depends on how the building is set up, what AMI level and how they operate and manage it. But that was pretty shocking to me. So it's only 39 units of the total. If it was a bigger proportion, I'd worry about it using a 3% collection loss.
I have a
Go ahead, Mr. Metzger.
completely different take on it. The proposed increase for to me, pretty stabilized property is 20% increase. Now, that seems to match what the assessment was from 2022. Getting it up to that level, which we reduced last year based on our own charge. And I feel that just doesn't, if we were correct in our analysis last year, there's no way in the world that we can be correct this year with a 20% increase, meaning the department's request.
Right, but we have more information now. We also have in 2022, look at what's reported.
Yeah, we only had
Stabilized.
we had the 6.2 million NOI, but 2022 they got
Yeah, it was really
7.8.
Kind
So
of
that's the
starting up,
difference.
and I think that was part of the.
Well, I saw the numbers kind of close, but maybe that's the answer. Now it's stabilized and it wasn't then.
It probably took them a little bit longer.
That's a good response. Thank you.
Yeah, it's actually, the assessment's actually lower than what they.
that's $1.4 million. I went up $1 million.
Yeah.
Yeah,
Yeah, good. Thank you.
$1.6 million.
$1.6 million. Okay.
And now we're down on the test, we're actually lower than we were in 22 on the actual.
Yeah.
Which to me kind of balances out the vacancy argument.
I was
The
hoping
low.
college deep through H and I made a mistake of not including C. I'm on board.
Yeah, I agree with pretty much everything was there, and I appreciate what you came up with, Barnes. I think it's useful information. Yeah, the only test that I did, it comes up with a higher number than the request anyway, 48. I'm okay with it, because I know the assessor used higher expense on the market unit than the guideline. I'm okay with it.
I checked with Preston Carruthers. I mean, Preston Crothers has passed, but his family continues on, and I have a relationship with them. Their occupants, their vacancy, all over Northern Virginia. Wow.
Okay, bringing us back to this, then with no further discussion, I'll go ahead and move to confirm the county. Do I have a second?
I'll say.
I've got Mr. Hoffman over here as a second.
Oh.
Okay, all in favor? Aye. Opposed? Unanimous. County's confirmed at 147,068,700. The next case on the agenda is RPC 35005023 at 901 15th Street South. Mr. Harmon, you can start with your 8 minutes and tell us about that property.
Yes, thank you. So this is the Enstrada Pentagon City Apartments. It was built in 2002 and has 325 units. The 2023 assessment is a 7% increase over the 2022 value. 3-year historic NOI has averaged just over $7 million. On page 44 of the board pack, you can see the 2022 INE, which shows January 1, 2023 vacancy at 9%. The average vacancy over 2022 was just under 5%. The issue on appeal is the cap rate. You can see on the test page, the assessment shows a cap rate of 5.293%. I want to emphasize this is actually two different numbers combined into one. This is the market cap rate plus the tax rate. So in order to get an apples to apples comparison of what the market cap rate is, we need to back out the tax rate of 1.073. And we see that we have a market cap rate of only 4.22%. This is the same rate this property has been assessed at for each of the past 4 years, and the lowest rate it's been assessed at for the past 15 years. By not changing the cap rate from 2022 to 2023, the assessment completely misses the effects of interest rates increasing dramatically over the course of 2022. The 10-year T-bill again increased 236 basis points. The SOFR increased by 425 basis points. This cap rate represents a spread of only 34 basis points from the risk-free rate of the 10-year T-bill as of year end. Now, backing up a little bit, our goal here is fair market value, which has been defined by the Supreme Court of Virginia as the price the property will bring when offered for sale by a seller who desires but is not obliged to sell, and bought by a buyer under no necessity of purchasing. Now, I want to delve into the relationship between the 10-year T-bill and the cap rate a little more. I know you've heard us all talk about this 236 basis point increase every case we've presented this year. So I want to look at this relationship and why it's important. When an investor is evaluating an investment, they first must develop a required rate of return. A required rate of return is the minimum profit the investment must generate. Chief among the considerations when calculating a required rate of return are the opportunity costs. For the opportunity cost, the 10-year T-bill is widely used as the benchmark due to its term and stability. The 10-year T-bill increased by 236 basis points over 2022 and was paying 3.88% as of the end of 2022. So if an investor can earn 3.88% risk-free guaranteed return by doing nothing other than purchasing a bond, this necessarily becomes the floor for the required rate of return for any investment decision. An investor must be able to earn a better return than the risk-free rate offered by a bond in order to provide the investor with entrepreneurial profit and to account for the risk that comes with alternative investments. The DREA has assessed this property with a profit and risk spread of only 0.34%. That represents the profit an investor will earn for finding and closing a deal, managing the property, and selling the property at the end of the hold period. That's a lot of work for only 0.34% profit. Keep in mind, these investments are not risk-free. You incur risk by the assumptions you make to underwrite the deal. If the market income or expenses differ from the assumptions you use to underwrite the investment, you could easily not achieve the returns you projected. If inflation is rampant, or if, as we saw in the second half of 2022, rent increases slow or even projected to decrease, your investment returns will be less than projected. This is risk. So that 0.34% spread the assessment applies has a lot of work to do. For context, the spread 1 year earlier in 2022 was 2.6%. This spread has averaged 2.2% over the prior 15 years. Again, it's only 0.34% this year. Now, I was curious also what the spread in the market has historically been. The most recent info I can find for a spread between just general apartment cap rates and the 10-year T-bill was info that's outdated. It was Q1 2022. It was a report by the National Association of Realtors. This report states that as of Q1 2022, the spread between apartment cap rates and the 10-year T-bill averaged 2.5%. That's in line with where these cap rates were last year at 2.6% spread. It is not in line with where they are this year at a 0.34% spread. So this leads to another question. Why pay so much attention to interest rates this year? Well, that 236 basis point increase in the 10-year T-bill is the greatest annual increase of any year over the past 50. For context, as I said in the last case, over the past 15 years, the average change up or down by the 10-year T-bill was only 75 basis points. That means 2022 saw an increase, a movement of more than 3 times greater the average than the 15-year average. Now, you've heard me quote market participants in the last case stating that this relationship exists. Higher yields on treasury bonds equals higher cap rates. We also see this in a survey of DC area investors and developers, which estimates Class A high-rise properties to trade at a cap rate of 5.11%, which of course you would have to add the tax rate to get a comparable cap rate to what the DREA has shown on their test page. This increase represents a 93 basis point increase year over year. This survey was completed during 2022, so it also fails to capture the full magnitude of the increases over the course of 2022. So I also want to speak to the SOFR, which is, of course, the secured overnight funding rate. This is the measure of the cost of borrowing cash overnight. This rate took the place of LIBOR several years ago. The SOFR represents the interest rate banks use to price loans. A commercial loan will be at a rate of SOFR plus a spread for profit and risk. So the SOFR was at 4.3% as of December 30th, 2022. This property's cap rate is only 4.22%. This means it would cost you more to borrow money to purchase the property than you will earn on the property. This simply doesn't pencil in. We've conservatively increased the cap rate by just 75 basis points to reflect the change in the market over the course of 2022. This brings the spread between the cap rate and the 10-year T-bill to only 109 basis points, which again is below the historical averages and below the spread last year of 2.6%. Now, I also want to speak to the Cortland sales. We did ask that owner what the cap rate they would pay as of January 1st, 2023 would be, and they said that had gone up quite a bit. So I apologize if I misspoke in the prior case and said Q3 2023. That is not what we asked that owner. We asked them, what would you pay as of the date of value, January 1, 2023? Thank you.
Thank you. Ms. Shuttlesworth for the county, please.
Yes, thank you. So again, the biggest contention here is the cap rate, which is based on 10-year Treasury note argument. The owner's representative contests the cap rate based on the 10-year note, not 10-year bill. I guess they're getting a little bit confused. The 10-year Treasury note is used by the investors as a benchmark to decide whether it's worth for them to take on a riskier investment. We understand that. But we are mass appraisers. We use different metrics. We do not use 10-year note. We never have as one of those metrics. We use sales to assessment ratios. We review hundreds of INEs provided to us to determine the trends in income, vacancy and concessions, and operating expenses. If we conclude that excuse me, I'm sorry, I'm hearing voices. Going back, if we conclude that the SAR ratios are trending above 100%, and we see consistent downward trends in income the properties generate, we act on it. And we decide whether or not cap rates need to be adjusted. We also consider the adjustments for market rents, vacancy and concessions, or operating expense ratios when needed. These are the metrics used by Arlington County and other surrounding counties. It is also important to stress the fact that we have strict timelines that we need to follow. Investors prefer to look at the most recent sales. We cannot look at the sales that occurred after our cutoff date, which is January 1. And again, for the sake of argument, even if we did use the 10-year note as one of our metrics, we would certainly not use just one day out of the year, like the appellant's representative did. They used only December 31st. This methodology is an equivalent of us considering just one sale that would occur on December 31st, and we would ignore the rest of the sales between January 1 and December 30th. One number does not make a statistical sample, and mass appraisal relies strictly on statistical approach. Regarding the increased cost of borrowing, we're not arguing the fact that SOFR and LIBOR rates have gone up. In fact, if the appellants have loan in place with unfavorable financing terms or have, let's say, balloon payment due and are unable to refinance or sell because the appraisal came in too low, we would like to hear about it. But again, the loan information section on the INE survey was left blank. And when you look at our summary sheet, you can tell why they're not contesting NOI. You can tell why they're not contesting our potential gross income, because we are so below the NOI they actually reported. So that's why they only contesting cap rate. That's all. Thank you.
Okay, thank you. Questions from board members? Mr. Lawson.
Yeah, I got a philosophical question for you, Jordan. I hear what you're saying about office cap rates, and I don't necessarily disagree. However, you're talking about buying T-bills versus buying an apartment in Arlington. Is it possible that the increase in value, the appreciation of this apartment asset in Arlington could beat buying T-bills? Could that make it more attractive to an investor, thus justifying the county cap rate? Is it possible?
Yes, that's fair. The question is how much more profitable. Right now, the cap rate applied says it's 0.34% more. You would have to get more entrepreneurial profit than 0.34% above the 10-year T-bill.
Rent growth.
Yeah.
I'm sorry.
That's based on no rent growth.
over time.
If you have a growth
And
rate,
at the end of 2022, we were seeing rent growth decrease and plateau. So the assumptions of 2020, 2021, 2022, they were starting to shift, and looking forward, the principle of anticipation.
if you take a spread on the cap rate and the treasury rate, you're not including a rate of growth on the rent,
And appreciation.
which most real estate investors are going to have some inclination that there's going to be a rate of growth that's somewhat aligned with the rate of inflation.
And understanding that, so I did look at the historical spread to see what is that assumption for the amount of growth. And as I said, the National Association of Realtors had that spread pegged as of Q1 2022 at 2.5%.
Yeah,
This
I guess,
assessment's only
and just to kind of put a nail on Barnes' point, real estate investors have very long memories and historical perspectives, especially when you're talking about buying apartment buildings that are worth hundreds of millions of dollars. And, if I can ask one further question, would you rather have a 10-year German government bond in 1920 at 5% yield, or a coal mine in Germany that you own at 20 times earnings? One is extremely risky. The other one is a lot less risky and is probably worth a lot more today. Let's say that the bond is worth zero, and it was worth zero within 3 to 5 years of that time.
Okay,
So investors are looking at that too. Hard assets.
okay, other questions? No, okay, Ms. Shuttlesworth, if you take a minute to wrap up, please.
Yeah, so again, I don't have anything else to add, except for that we have some limitation on the software side, and we had to slightly adjust the cap rate from 5.29% to 5.293%. So there will be a slight decrease to the 2023 assessment. And so we asked the board to revise the 2023 assessment from $139,410,700 to $139,331,700. Thank you so much.
Okay, thank you. Mr. Harmon, if you take a minute to wrap up, sir.
Yes, thank you. So I'm looking at page 10 of the board book that we provided to the board and to the county. And this shows the historical spread between the 10-year T-bill and the cap rate. And over the past 15 years, that spread averaged 2.19%. This property is 0.34%. So even, accounting for appreciative growth in rents, assuming that's not going to be outpaced by operating expenses. Historically, this is how the DREA has assessed these properties, with a spread of 2.19%. This property is only at 0.34%. Thank you.
Okay, thank you both. Okay, so someone on the board.
Yeah, I mean, those 10 years of declining interest rates. So it's not the same when they're rising. The treasury value gets cut in half in a rising interest rate environment. That's what caused a bunch of banks to fail earlier this year.
This project has no low mod housing due to the fact it was the residential density was site plan approved. Then the overall Pentagon City approval. And so then when this project came about, they were just using already approved residential. And the increase per unit per month is $20. So I think that the value is fine.
Especially, and it just seems a little bit more because we lowered it last year based on the 1 year or lower.
Oh, there's move outs, all that stuff.
Yeah.
We're looking at that data.
Yeah.
Yeah.
Okay, somebody want to make a motion?
All right, I'm motion to confirm the county's revised assessment at 139,331,700.
Do I have a second?
Second.
Mr. Lawson? Okay, motion and a second. All in favor? Aye.
Aye.
Opposed? County's revised assessment of 139,331,700 is confirmed. Thank you.
Thank you.
Moving to the final case, RPC 2400204A at 319 South Wayne Street. Mr. Harmon, you can start with your 8 minutes and tell us about this one.
Yes, thank you. So this property is 32 units spread across 4 buildings. The assessment imputes a 2% increase in NOI, while this property has consistently achieved NOI of right at $390,000. The issue on appeal is the cap rate. Again, you can see once we back out the tax rate, this is a market cap rate of only 4.97%. Now, this property is unique from the other properties we've spoken to. It's older. It was built in 1940. It has been updated throughout the years, but it's still older. It's small units that don't rent for much. This isn't a premium building. It's going to be limited in the amount of rent increases it can achieve in the current market because of the market it serves. Now, I want to also speak to amenities. The DREA write-up states that this property has amenities, fitness center and whatnot. Those are actually down the street at another apartment building. So those aren't on site. Those are, I want to say 2 or 3 blocks down the road. So it's not well amenitized. It is limited in the amount of rent growth that it can achieve due to the market it serves. And the cap rate is only at 4.97. This is below what Class A high-rise apartments were surveyed to be at last year. At the end of last year, a local market survey came in at 5.11% for Class A high-rise apartment cap rates. The same survey showed suburban Class B apartments getting closer to what this property actually is at a cap rate of only 5.63%. Again, this property is, once we back out the tax rate, is at a cap rate below 5. The 5.63 from the survey for suburban Class B is right where we're at on our appeal. Thank you.
Okay, thank you. Ms. Shuttlesworth for the county, please.
Yeah, so subject properties, again, 32-unit garden style apartment complex built in 1940. The property was extensively renovated in 2013, I believe 2014. And the updates include stainless steel kitchen appliances, new cabinets, granite countertops, and new bathroom vanities. It has effective age of 2000, and again, the property features include fitness center, resident lounge, clubhouse, which is across the street, as Mr. Harmon stated. An interior exterior inspection was conducted on June 26th. An informal hearing was held on June 22nd. And the appellants are contesting PGI, OPEX, and the cap rate. We have reviewed the submitted I&E surveys for 2019 through 2022. In 2020 and 2021, the subject property was experiencing decline in GPI and NOI, which was probably triggered by COVID-19. In 2022, the GPI noted a 4.04% growth. 4.04% growth. However, the OPEX per unit has increased by over 6%. We do recognize that. The 2022 NOI increased by only 0.32% when compared to the 2021 NOI. And it hasn't reached the pre-pandemic level. We also acknowledge that. Maintenance and repair costs increased by 41% due to plumbing issues and water intrusion caused by the roof leak. We did not exclude it, but we do recognize that this is not an ordinary expense. Therefore, the total OPEX that you see reported on the 2022 I&E is slightly overstated. In the 2023 pro forma, the appellants used the cap rate of 6.75%, and per 2023 guidelines, supported by the market data and high volume of I&Es provided to us, we applied a 6% cap rate. In the 2023 pro forma, the appellants used the cap rate of 6.75%. Yes. DREA was very conservative with the rental income used in column F, as you can see. These rents are well supported by the actual rent roll provided to us as of January 1, 2023. With the above proposed revision, we recommending reduction from $7,118,000 to $6,641,100. And after the application of rehab partial exemption of $647,700, the subject's 2023 assessment will be further reduced to $5,993,400. Thank you.
Thank you. Questions from board members? No. Okay. Any final comments, Ms. Shuttlesworth?
No, the only one thing that I wanted to stress is that the operating expenses reported in 2023 is slightly overstated because of that unusual leak emergency they had to deal with. And I don't know if I can tell the dollar amount of the repairs, but that's about it. Thank you so much.
Okay, thank you. Mr. Harmon, if you take a minute to wrap up, sir.
Yes, thank you. I just want to address, we've heard the DREA account. They say cap rates are supported by the I&Es they receive. The I&Es don't request a cap rate. They don't have a section for a cap rate. So that's, I believe that's a misstatement by the DREA. Now, they also don't have sales to support it. As I went through their sales, their first sale listed most recent to the closest to the date of value was a redevelopment project. The next was a committed affordable, and the others from there on were Q1 sales. So, those sales don't capture any of the changes that took place over the rest of 2022. Thank you.
Okay, thank you both. Okay, it's just among the board. Mr. Lawson.
Yeah, I'll go ahead and start. See if anyone agrees with my thinking. I think on the revision, it's just a little bit aggressive on apartment rental. So I reduced it. I just felt like an appropriate figure was 15,000. When I did that and you go through it, I ended up at 6,391,000.
So 50,000, what number did you say?
I reduced the apartment rent by 15,000.
I 50.
And the reason I did it was, this appears to be, it has a high, a high vacancy rate, higher than the norm of the 6%. And I'm guessing this is only 32 units, so I'm guessing they're struggling getting units, getting tenants replaced as they vacate. So anyhow, that was kind of my thinking. I think that the county was just slightly aggressive.
I'm sure, at that rate that the county is using at $14.20 per month on that unit, it's much lower than what they're asking right now.
Where's everybody else?
I'm okay with it. I was okay with the last year too.
Test a lot better than the original.
Yeah.
A lot
Yeah.
should be more.
I mean, underpinning it is also, these are small buildings, 200,000 a unit for a condo conversion. Probably gonna push that value up if you wanted to go condo with something like this, but that's not what's driving it.
Okay, all right, somebody want to make a motion then?
I'll go ahead and we confirm, we revised assessment, the 5,993,400.
Second.
Okay, we have a motion, a second by Mr. Metzger, all in favor? Aye. Opposed? Unanimous. The assessments reduced, including the partial rehab tax exemption, to be 5,993,400. Thank you. That completes the agenda. Any other business before us? Okay. We will stand adjourned then at 11:04. Reconvene tomorrow morning at 9 a.m.
Thank you all.
Everyone.
Okay, just for everybody